So, usually when rockets start flying and global oil shipping chokes up, you'd expect markets to just completely panic, right?
Oh, absolutely. It's a classic flight to safety.
Yeah, but today we're looking at July 20, 2026, and that old playbook just got tossed right out the window. Welcome to today's deep dive, where we're analyzing how Bitcoin absorbed a massive energy shock overnight.
Right. While the underlying corporate and physical infrastructure basically shifted beneath our feet, the main trigger here is the geopolitical macro picture.
Because we had those overnight U.S. military strikes hitting Iranian infrastructure, right?
No.
Near Bushehr and Darkovan.
Exactly. And the ripple effect was instant.
Yeah.
I mean, we saw transit through the Strait of Hormuz drop by 47% almost immediately.
Which is a massive chunk of global oil supply just bottlenecked. That pushed Brent crude way past $90 a barrel.
Yeah, which normally sends risk assets into an absolute tailspin. And, initially Bitcoin did take a hit. It dipped down to $63,692 as people pulled back.
Right, just shedding risk.
But then it just snapped right back up to $64,944.
It's like a digital shock absorber running 24/7. I mean, do you think investors just saw the oil spike and immediately front-ran the fiat inflation?
Well, yeah. Capital allocators looked past the military conflict and just saw the incoming inflation. They know a fixed supply asset is functionally immune to a physical supply chain bottleneck.
But here's where the narrative gets a little messy, right?
Yeah.
Because if you look at how major corporations are actually behaving, they aren't all just blindly hoarding Bitcoin right now.
Oh, not at all. Look at Strategy Inc. I mean, they are the absolute poster child for institutional hoarding, but they just sold $263.5 million in stock.
And let me guess, they bought 0 Bitcoin with it.
0, exactly. They used it to build a massive $3.2 billion cash reserve instead.
Wow.
Yeah, and meanwhile, you have major miners like Bitmine pivoting really hard into yield. I mean, they took 85% of their 5.78 million Ethereum and staked it.
Wait, so they are pulling in what, like 247 million in revenue from that?
Right. It's basically locking up digital assets to generate steady fiat cash. You do have a few players like Strive grabbing, 21 new BTC, but they are sort of just nibbling.
Okay, so let me push back on this a bit. If Bitcoin is supposed to be this ultimate hedge against geopolitical inflation, why are these massive players like Strategy Inc. suddenly prioritizing US dollar cash buffers over just accumulating more digital assets?
Well, because a corporation still has to pay its real-world bills. If you have preferred stock dividends to pay out, you need cash.
Ah, I see.
Yeah, they aren't abandoning their crypto thesis at all. They are just building a defensive moat. With billions in cash, they can survive market shocks without ever being forced to sell their core holdings.
Right, which makes total sense from a corporate pragmatism standpoint, but we're also seeing that exact same survival instinct play out in the physical hardware space, aren't we?
Oh, massively. Just look at LM Funding America. They literally just changed their name to Power Compute Inc.
PWCM, right?
Exactly. And they shifted 26 megawatts of power capacity down in Oklahoma and Mississippi away from crypto mining entirely.
Just unplugged it from mining and routed it directly into high-performance computing and AI.
Yeah, directly to enterprise AI clients. It is a pure margin play. Mining is just so capital intensive right now, and renting compute to AI offers a vastly superior return.
The irony there is just incredible to me. The physical infrastructure that was built specifically to secure crypto is now actively being cannibalized by the AI boom because of the higher profit margins.
It really is wild. But while the physical operators are fleeing to AI margins, Wall Street is actually deepening its financial infrastructure for Bitcoin.
Right, the paper side of things, because NYSE Arca just quadrupled the options limit for the IBIT Trust, didn't they?
Yeah, up to 1 million contracts. That scale is just unprecedented for this space. It allows massive institutional managers to deploy really complex hedging strategies.
And the timing on that isn't a coincidence, right? With the SEC's pending crypto assets rule dropping this July.
Exactly. Everyone is waiting to see exactly how these massive funds will have to report and collateralize those specific trades.
But I have to ask, how do these massive derivative limits actually change the baseline volatility of the asset for you and me, like the everyday holders?
Well, it essentially acts as a sponge. When institutions can hedge massive positions with options, They don't have to panic sell their actual, physical coins during a crisis.
So the derivatives market just takes the brunt of the chaos.
Exactly, which over time creates a much smoother, stable price for the underlying asset.
Which brings us to the big picture here. You are watching an asset survive global military conflicts and these crippling energy shocks operating 24/7, while its biggest corporate players and physical miners are just radically adapting their strategies to survive.
Yeah, the paradox is that for Bitcoin to survive as this decentralized rebel asset, it's forcing its biggest players to act with the ruthless pragmatism of traditional Wall Street banks.
Right. Which leaves you with a really fascinating question to ponder as we wrap up. If institutional derivative contracts and these massive options limits grow large enough to essentially dictate Bitcoin's price action, does the asset permanently lose its original identity as a purely non-sovereign independent currency? Definitely something to think about next time you check the charts.